in Part A of the required. First, you need to analyze and interpret the investor ratios relating to Excel. All right, so if we need to analyze and interpret, you're going to have to perform calculations and then also discuss those calculations. So you can see just below, there's 4 marks available for the calculations and 8 marks available for discussion. And we are specifically looking at investor ratios. Now guys, if you go back to the information provided in the scenario, we have not been given a lot of financial information relating to Excel. The only information that we have is the earnings per share and the share price for 2019 and for 2018. So there are not a lot of investor ratios that we can calculate. So remember guys, go back to your lecture notes. You'll see I've provided you with all of the investor ratios. So you're going to go through that list of investor ratios and see, based on this information that you've been provided with over here, what can you calculate. So we can definitely calculate the movement in earnings per share. So we can calculate what this increase is from 2018 to 2019. We can also calculate the movement in the share price from 2018 to 2019. In addition to that, if we have earnings information and the share price, we can calculate the price earnings multiple. Remember, we calculate the price earnings multiple by taking the share price and dividing by earnings. And then, once you have that price earnings multiple, you can also calculate the movements in the price earnings multiple from 2018 to 2019. But based on the information that we've been provided with, those are the only calculations that we can perform. All right, so let's start with the calculations. Once we are happy with the calculations, we'll then move on to the discussion. All right, and I don't want to waste your time, guys, because this is obviously very straightforward calculations over here. So I am just going to jump to the suggested solution and make sure that you're happy with everything. So firstly, to calculate the movement in earnings from the prior year to the current year. Remember, whenever we are calculating a movement, you take the current year, you subtract the prior year, and you divide by the prior year. So let's calculate the movement in earnings and the movement in the share price. So first, movement in earnings per share. Take the current year, subtract the prior year, divide by the prior year, and we can see that earnings per share has increased by 25% from the prior year to the current year. Performing the same calculation for the movement in the share price, take the current year share price, deduct the prior year share price, and divide by the prior year share price. So you can see that the share price has increased by 33.77% from 2018 to 2019. All right, then next we said we can also calculate the price earnings multiple, and you calculate the price earnings multiple by taking the market value of equity, or the share price, and dividing by headline earnings. And so obviously this is the official formula, but the only earnings information we have is the earnings per share. So we are going to use the information that we have. So just take the share price and divide by earnings per share in each year and calculate the multiple. All right, and then guys, please remember this is a multiple, meaning it's just a number. So this is not a percentage. You shouldn't say over here 12.2%, etc. This is just a number. You just say 12.2. All right, it's a multiple. And then finally, we can calculate the movement in the price earnings multiple. So remember, we calculate the movement by taking the current year multiple that we calculated above, deducting the prior year multiple, also calculated above, and then dividing by the prior year multiple. All right, so you can see the price earnings multiple has increased by 7.02% from 2018 to 2019. Okay, and those are the only calculations that we can perform. Now we need to move on to the discussion and discuss what we've actually calculated. Now, in our lecture, I provided you with a framework that you should use for the discussion of your ratio calculations. And in terms of this framework, first we are going to interpret the calculation. We are then going to compare it to a benchmark. And when we make the comparison to the benchmark, you need to use the correct terminology. So you can't just say increased or decreased. You need to show that it's improved, it's deteriorated, it's better, or it's worse. Then, after comparing to a benchmark, if possible, you try and provide a reason. And then finally, if we have negative performance, you are then going to discuss the impact of that negative performance and, if possible, provide remedial action. So how can that negative performance be improved or corrected? All right, so that framework will help you with your discussion. So first, if we start with earnings per share, we need to first interpret the ratio. Now remember from our lecture, guys, I said to you, some ratios you won't need to interpret because the interpretation is self-explanatory. And this is one of those. Your earnings, the movement in earnings per share is the movement in earnings per share. Either your earnings per share has increased or it's decreased from the prior year. So there's nothing really to interpret over there. Then when it comes to comparing to a benchmark, we have not been provided with any information relating to a competitor. We haven't been provided with any industry averages. So the only thing that we can benchmark is to the prior year. So we can see that earnings per share has increased. So in other words, it's improved by 25% from the prior year to the current year. And that's the only benchmark that we can do. At this point in time, we can't really give a reason why the earnings per share has increased. We don't have any information provided in the scenario. We'd just be purely guessing right now. And this is obviously not negative performance, so you don't need to worry about discussing the impact or remedial action. So the only thing that we can discuss for the movement in earnings per share is the comparison to the benchmark, where we can see earnings per share has improved by 25% from 2018 to 2019. Then if we look at the movement in the share price, first, let's interpret. Now, we can definitely score marks by interpreting over here. Because remember, guys, the share price doesn't actually reflect the value of the company's underlying assets and liabilities. This isn't based on a valuation. The share price is determined by supply and demand. If there's a very high demand for the company's shares because the company is performing well, then the share price will increase. If the company is not performing well, then everybody's going to want to sell their shares in that company, so there'll be an oversupply of shares, and that will cause the share price to drop. So this is based on, or the share price of the company is based on supply and demand, and it's driven by the market's perception of their future growth prospects. So the fact that the share price has increased so significantly from 2018 to 2019 might be indicating to us that the market believes that Excel is going to experience higher growth in the future. And because they believe they are going to experience high growth in the future, everybody wants those shares. So because there's a high demand for the shares and there's not a lot of shares in circulation because everybody wants them, that then obviously drives the share price up. All right, so once again, let's just go to the comments over here. So first we are going to interpret this. So the movement in the share price is driven by supply and demand, which is affected by the market's perception of Excel's future growth prospects. So we said that the share price improved. So remember, when you're comparing to a benchmark, make sure that you use the correct terminology. Don't just say that the share price increased. It improved by 33.77% in the current year. And the reason for this, or one potential reason for this, is because the market believes that Excel will experience higher growth in the future. Because we said above, this is driven by the market's perceptions of Excel's future growth prospects. So if the market believes that they will have high growth in the future, there will be a demand for the shares, and that will cause the share price to increase or to improve. All right, and once again, obviously, an improvement in the share price or an increase in the share price is positive performance, it's not negative performance, so we won't be able to discuss the impact or remedial action of negative performance. Then for the price earnings multiple, once again, you can see we do have an improvement. If we look at the movement from the prior year to the current year, the price earnings multiple has increased. How do I know that that increase is an improvement? First, let's interpret this ratio. What does the price earnings multiple tell us? This tells us that investors are willing to pay 12.2 times more than the most recent earnings when purchasing shares in Excel. Because look, the share price is obviously what the investors are prepared to pay relative to the earnings in the company. So investors are prepared to pay 12.2 times more when they are buying shares in this company. They're prepared to pay 12.2 times more than the current earnings of the company. So obviously you want this multiple to be as high as possible, because then it means that investors are prepared to pay more for shares in your company. So that deals with the interpretation of the price earnings multiple. Okay, there's actually a little bit more interpretation. We'll get to that as well now. But let's just deal with what we've already got. So the price earnings multiple indicates that investors are willing to pay 12.2 times more than the most recent earnings when purchasing shares in Excel. And we said the multiple has increased or improved by 7.02% in the current year. Now guys, we can take this interpretation. Remember, first we interpret, then we compare to a benchmark. This interpretation over here, we can actually elaborate a little bit further on, because we know that a high price earnings multiple either indicates that the company is low risk, or it indicates high future growth perceived by investors. So the fact that the price earnings multiple has improved from the prior year to the current year, and you can see we can actually tie this back to what we said with the share price above. We said the share price, the reason why the share price has improved so significantly is probably because the market or investors believe that the company is going to experience high growth in the future. And this is also confirmed now with the high price earnings multiple, because a high price earnings multiple either indicates low risk or high future growth. So the fact that their share price is increasing very significantly, and also the price earnings multiple is increased, indicates that investors expect the company to have higher growth in the future. So just to wrap this up, you can tie these two calculations into each other, and you can say that this is confirmed with the higher price earnings multiple, which is discussed just below. Both of these things are telling us the same thing, that the market believes that the company is going to experience higher growth in the future. All right, it could also mean that the investors perceive the company to be low risk, which we've addressed over there. All right, then, so we've interpreted, we've compared to a benchmark, we now need to give a potential reason. So, what is the reason for the increase in the price earnings multiple from 2018 to 2019? Guys, it is because the share price over here is growing at a faster rate than the earnings. And you can confirm that with the calculation above. The share price is growing at 33.77%, whereas earnings are only growing at 25%. So because the share price is growing at a faster rate, that has caused the price earnings multiple to increase from the prior year to the current year. All right, so this is the reason. This is because the share price is growing at a faster rate than earnings. And link that into the calculations that you have performed. All right, then once again, we don't have negative performance over here. The increase in the price earnings multiple is obviously improved performance from the prior year to the current year. So you don't need to discuss the impact or any remedial action for negative performance. Okay, let's just jump back to the required. We've answered part 1 of A. We now need to answer part 2. What additional information would assist you in your analysis? And this is only for 1 mark. All right, so if you could have any additional information, what additional information would you want to have which would help you in your analysis over here? Now guys, we saw when we were discussing these ratio calculations over here, the only benchmark that we could compare to is the prior year, because we didn't have any competitor information and we didn't have any industry averages. Now, this analysis over here would be a lot more meaningful if we could benchmark to an external company, not just from the prior year to the current year. So it would be great if we could have information relating to a competitor company or industry averages, because then when we are discussing performance, we can compare Excel to an external benchmark, to an external company, and say whether their performance is better or worse than the external company. So that's what I was looking for over here as your answer. We need industry averages or competitor information for benchmarking purposes, and that would assist us in our analysis. All right, so that then answers part A of the required.